David says, Michael, in the bull put search, I'm getting number of impossible fills. I define this by summing the percent return and percent probability above with a sum greater than 1. Example, 40% return and 80% probability above. I will typically select that option in the custom spread and change date to current and check the Black-Scholes value to get a valid price on the position. Are there ways to limit these out of price positions? I'm going to need more information, okay? So my ones are 10, 15%, reasonable bid-ask spread, 16, 17, 18%, 13% return with 85% probabilities. This one, I can tell you right now, I wouldn't even look at, wouldn't spend time with. Anything I see, here's one tip, David. Anything I see with a 0 bid and a 64-cent ask, even if it came out after hours, but Monday would be back to normal, I don't look for those. Okay, I don't even waste my time because there's no way I'm going to get 60 cents. There's no way I'm going to get probably 35 cents for this particular option. So, limitation, option bid, minimum, at least 1 cent. I like to use the short bid-ask spread to limit those as well. Let me clear the filters, David, and you're saying a percent return of 40, right? Probability of 80. David, I don't know your time frame. Yeah, let me just go next week, 1 to 8 days out in time. And I'm just going to leave it at that. See if we see anything similar to what you're seeing. Yeah, perfect. 97% return. Where's my I'm sorry. This ridiculous number. It doesn't exist because it's saying that there's a 0 bid on this 124 put. We can't control that. That was shot out across the exchange, maybe at the close of day. Anything that has a 0 bid and an ask of 5, I'm not getting $2.50 for this. I'm not getting $1.07 for this. There's no way. Okay, as soon as I put in an entry to sell this at $2.50, you know what I'm going to see, David? The price is going to change on the market instantly. The bid might stay at 0. The ask is going to go to $2.50. I change it again and put in 125. The bid's going to stay at 0. Now the ask might go down to 67 cents. Every time I put in an order to sell, he's going to keep cutting it and cutting it and cutting it. So these are some ones. Let's take it out. Option bid greater than 0.01. Never hurts to make sure the thing is traded. Some reasonable open interest, maybe some option volume today. Again, I prefer to limit the short bid-ask spread to less than 50%. But let me not do that yet, David. Let me not do that yet. Let me take those out. See what that gives us. Okay, so now we're still seeing things here. Yeah, 50 to 239. No, I'm not getting the midpoint price. I'll get the midpoint or close to the midpoint on this one. 145 to 190, possibly. But getting the midpoint 65 to 145, it's debatable. That's why I'm going to go back here to help me save time. Maybe it's not the spreads that you want, but I want to save time. Okay, so here's still some ones with a 56% probability. So OC, yeah, I tell you right now, looking at 3 or 4 of these, I wouldn't trade them anyway. Personally, David, that's me. OCGN at 1184. The 5th of November, remember I just went out 1 week. The 5th of November, 9 strike, 54 bid, 67 ask. I could see getting 60 cent midpoint on that. I don't think that's too bad. 38 to 47. Yeah, I could probably get filled in that. Midpoint net credit, 18 cents. I'm sorry, it's the 850, so it's a 50 cent strike difference with an 18 cent net credit. And based on the past trading range of the stock, I'm going to go to big charts here, where it's been. Yeah, lower volatility, 9 and 850. Yeah, that's probably wouldn't do this, but it's been very volatile recently and moving around. So for the next 7 days, there is an 81% probability that it would stay above the strike. That's 56% return. Looking at these, I don't think the fill prices, the bid-ask spreads are that bad. I think it's possible. And even if you only got 15 cents, you'd still be at a high return. Okay, and the probability is 7 days away, so the probability is still relatively high. If it was 14 days away, the probability would probably be lower, of course. But I'd have to research the heck out of this. Why is this thing so up here in volatility? 2.9%. You know I don't enter trades with that volatility at all. I don't even go near that. I probably wouldn't even go near IAC. Now, Qualcomm's an interesting one, isn't it? 125 to 160, 96 to 122. That's a little bit wider than I'd prefer, but I still might be able to get 28, 30 cents on that. Possibly. It's not too big. What's my 48 one here? Oh, BKNJ. Yeah, 8-point bid-ask spread. That's a little tough, even on a $2,320 stock. Limit the bid-ask spread. Make sure you're looking for a positive option bid, at least greater than 0. I usually go greater than 5 cents, and some liquidity as well. And of course, one thing I should mention, what I would always do, and this is a wide open search, isn't it? We're looking 7 days out. Anything, well, that's restricting. A 40% return with an 80% probability, but to look for things that have a reasonable bid-ask spread and at least some bid price listed across the exchange, there's only 11 total spreads. Now I got to remove that earnings between now and expiration, even though it's only 7 days away. I don't want any surprises. Nothing. That's what I'd expect to see because I put in that bid price of 0. Okay. And I could see the Black-Scholes value quickly. Let me take that back out again. Let's go back 2 steps, David. Let's go back to that ridiculous one I saw. We're going to take out the bid. We're going to take out our 50% bid-ask spread. Where is the big ridiculous one I saw? Yeah, well, not the alphabet one so much. Applied materials is 0 to 214. I thought there was a bigger one. It might have changed. Okay, well, let's take AMAT. It's there. David, let's just use it. Stock's at 136.65. The November 124 shows a bid of 0 and an ask of 214. As I mentioned, if I tried to go midpoint here at 107, the minute I place that order, I'd expect to see the bid stay at 0 and the market maker change the ask price, electronic or real, to 107. He's trying to get me to 53 cents. Puts it in at 0. I put it in at 53. And for my midpoint, what's he probably going to do? Now I'm going to see the bid stay at 0 and the ask go up to 53 cents. He's trying to get me to 25. And he's going to keep doing that until he gets what he wants, most likely. Now, let's go to research and the short put research in this case. So this gives us all of the data that we have for the position. Yeah, so the Black-Scholes based on the SIV is only 5 cents. What does that mean? That means using the Black-Scholes calculation based on the 20-day volatility, 50-day volatility, it's just 1 cent and 3 cents. That's where the theoretical value is. Now, you can't filter them out in that case, okay, by Black-Scholes ratio. But, oh, yes, you can. I'm sorry. I didn't realize that was in there. You could look specifically for Black-Scholes ratios that are, let's see, what is my Black-Scholes ratio? I'm sorry. Yeah, it's essentially 0. So I could look for a Black-Scholes ratio of at least close to 1 or greater than 0.9 or greater than 0.7. That would, if this is your issue that you're coming across, David, that's the simplest thing to do. Just put in your Black-Scholes ratio cell of, say, greater than 0.8. So the Black-Scholes value is close to what the price is. Okay, so let's do one more quick one here. Again, I don't know the time frame, David, but doing those 3 things, I think, would limit it. You said you're already using the 50% bid-ask spread. Make sure you're putting a bid of greater than 0, and use that Black-Scholes ratio of at least greater than 0.8, maybe 0.75. You'll be fine. It'll take it out. But let's try your search. 15% return. I'm assuming we're sticking with an 80% probability. Bid-ask spread less than 50. And of course, this is going to be different because, as you're right, you're seeing the market move during the day. You're seeing different changes. You're seeing the market maker, unless I'm one-on-one with you on a coaching session, we're walking through it and refreshing every second during our whole conversation. I'm probably not going to see what you've seen. Oh, no, I didn't want that. Okay, let me start square one. Weeklies. Minimum 15% return, short bid and ask spread. Okay. All right. Okay. 0 and 74, 77 and 82, 350 to 485. These look pretty normal right now. I know that's not all of them, but you have over 600 results. Okay? Some of these returns, yeah, they're showing, yeah, that one's going to be really high. Of course, we know that. Now, of course, we would put in no earnings between now and expiration, but let's just do our other steps. Black-Scholes ratio of the cell greater than 0. Let's just go 7. 0.7. It can be undervalued, it can be overvalued, but it's at least relatively close. And I'm going to go too high on the upside, less than 150. Yeah, let's do 190, 1.90. Oh, so there's still some positions here. 28.40, 10.90, 77.82, good bid-ask spreads, close to the strike price, 73, 72.50 there. Implied volatilities look reasonable. Yep, there's one. Expected to see that. Oh, there it is, Ocugen again. Same one we were looking at, only the 8 and the 750 at this time. Now, I could restrict this further. Of course, do that there. Now, let me put in my bid. Let's just see what that did for us. Just lower that down. I mean, these are high returns with a high probability, but if these are the prices you exchange your list, okay, that might be a little bit of a stretch. What is VanEck 196 Black-Scholes ratio? I got a bid of 165 on the 196 and the 225. Let's check that there. So this is something that you can do on your own, David. I'm just going to spend another second on this. You can do it. Look at the ones that don't match. Go to the research tool. See what your Black-Scholes ratios are for 20-day and for 50-day, what the Black-Scholes ratio is for the SIV, the current option price divided by its theoretical worth, and then say, okay, you don't think you're going to get filled at those prices, you think that return's too much, so you're not going to get filled, and just come back to the credit spread and say, you know what, go back down here to 1.5, and let me do the same. And this Black-Scholes ratio here, by the way, is the 50-day. I'm pretty sure it's not the SIV. I can verify that for you, but I'm almost positive that's what it is. So I'm going to look for both of them. Keep my, oh yeah, I'd put some open interest liquidity. That's fine. But yeah, bid-ask spread limitation. Black-Scholes selling by. Ocugen still comes up, but it's a reasonable bid-ask spread, and there are some positions. We see there the Alphabet one with a 5-point bid-ask spread. Okay, that's likely on a $2,800 call or put. Sorry, we're in puts, aren't we? Yeah, Affirm here, 330 reasonable, 285 reasonable. It's a 29% return with an 80% probability. But again, what are we talking about? Make sure you research and analyze the position to make sure in that case. Yeah, moving pretty well, Affirm is after that big jump. Well, it's been up and down, I guess, hasn't it, David? Yeah, that's not what you're asking about, but there we go in that case. So yeah, you can, if you're starting to see ones that you think, when you look at the Black-Scholes ratio, you think it's too far out of bounds, just lower your limitation. And you don't think you're going to get filled in a reasonable price, lower your limitation. These ones I'm seeing here, can't guarantee that I would get filled on them, David, but they don't look too out of bounds to me at all. 11 cents here with this volatility at 200%. Shopify is interesting. Yeah, it's a 3-point spread, 320 spread. Still 38.9% return. The volatility is nominal, 37.50. Short option delta 0.16. Yeah, I mean, those look like reasonable bid-ask spreads to me. But, again, if you're thinking that they look too overvalued based on their Black-Scholes, you're not going to get filled on them, or you're not getting filled on them, then just lower your Black-Scholes ratios down to a more lower level to help you save time with the positions that match your criteria. While I'm here, let me just check it. We have 132 results, 17 days out. Narrowed it down to 59 with the earnings coming up. Lucid, yeah, that doesn't surprise us, does it? Lucid's in there as well. It's probably extremely overvalued in that case. Yeah, and you said, I'll try the suggestions, but a 39% return with the 83% above theoretical probability will not get filled. I've tried. Okay. So yeah, I'll have to take more of a look at it next week. But some of these here, I understand what you're saying. But the bid-ask spreads and what the volume, if there's volume and open interest, they don't look out of bounds. Yes, we're seeing some ones that have a higher implied volatility from the movement, David. Again, that's what we expect. Yeah, this one's 50 cents. I'm just curious on the video. It's the 237.50 on the 25.67. Oh, my bid, I'm sorry, is 163 to 218. So that's not bad. I mean, it's a little bit above, but it's at 123. But again, where's our volume? Yeah. Current volume today, supply and demand, 25. We said the bid was 163. The last price today at 3:49 p.m. was $1.69. Well, now that's closer to the bid than to the midpoint. I get it, right? That's closer to the bid there. It's 169 instead of 218. What we don't know is at 349, what was the ask price listed? Was it closer? And then the end of the day run came through, and then this was the fill. This is one of those things I mentioned, David, why I have to sit there almost looking at this search during the trading day, refreshing it time by time to see in that case. Okay, Fernando has a quick question, and it's a quick question because I don't have an answer, and it's not something I do personally. Let's go back to LCID. I don't know if investors, any of you guys do this, or you think you have an insight into it. Fernando says that there a way to understand the stock direction only by watching the option chain. Not to my knowledge. Or at least decode the idea of the market maker. Well, decoding the idea of the market maker is to make money. He's tried to make money between the bid and ask spreads with volume and open interest and filling orders, technically regardless of which way the stock goes. Yes, he might have a bias one direction or the other. We won't know that. I don't know if he can do that by SEC rules, honestly. But he's making between the bid-ask spread. So look at these positions, and hey, the biggest bid-ask spread is that's 5 cents, that's 10 cents, that's 20 cents, that's 20 cents. Bad example. That's 25 cents. Yeah, so all the bid-ask spreads here are marginal. Consider where they're being. The at the money for this particular expiration, 358, they're almost equal. There's no discrepancy one way or the other. David says, look at the IV difference between the put and the call. And a lot of times, yeah, the puts might have a slightly higher IV on this particular stock. Why is that? Because I'm looking at Lucid that just had that sudden run up. Thought is possibly that the market, not the market maker, but the market is expecting, perhaps with a higher implied volatility and maybe the more interest in the puts, that Lucid has to pull back after this large run. Doesn't mean it's going to. You can see here that all of them are higher where it's not much. 2.12 versus 2.10, 2.08 versus 2.07 as we get to the higher strikes, go deeper in the money. 1.593 on the in the money call to 1.635 for the out of the money put. Okay. He meant all of them, Fernando, not just one strike. David says, look at the IV difference between the put and the call. He means all of them, not just at a delta of 0.3 or delta of 0.4. He's talking about looking across the board. And this is just for one expiration. And of course, you could use the volatility skew tool. We were on Lucid, is that correct? Again, and I could go to November 29th expiration. And I can look for a strike skew here between the calls and the puts, and some bad data in there on the calls, it looks like, with ones going to 0. But in general, you see that the put is slightly higher, but that's kind of a strange view because of everything going on there, Fernando. So David says to look at the IV, but again, the market's going to dictate where the stock moves. The IV is just giving you an inclination of, are the puts being more favored now than the calls? And then check the volume and open interest. Does that mean more people are thinking the stock's going to go bearish or bullish? Well, maybe they can drive the price down. But again, not something that I really do for the direction of the stock, is try to gauge it based on the options on a full option chain. That's me personally. So, Fernando, I don't have a great answer for you. David helped us out there by making a suggestion. Just not something I do or I've ever honestly paid attention to. In the sense that, yeah, I mean, I remember the old days, and I think, Fernando, you were with us when this happened too. I know it's not there now. 4 years ago, maybe you weren't, but a while ago, remember? Okay, it's gone now. I knew it was gone. I was wondering if I could go. I can't go historical in this account that far back. We would look at a chain of SHLD. Let me see if, was it OCGN? Yeah, Ocugen. Okay. So this is interesting. See, the calls, that's very skewed, isn't it? Seems like the calls are, oh, that's today. Never look at today's expiration. Let's go 14 days out. My apologies. That's much better. Yeah, see, in this one, the calls are slightly higher than the puts as relative to IV. You know, we're looking at 2.7 versus 2.75, 2.8 at the 1150 versus 2.71. This is reverse the other stock. The calls have the higher implied volatility on Ocugen than the puts do. Whereas on Lucid, the puts had the higher IV ratio, I should say. It's quite interesting on those too. So hey, a week from now, who's up and who's down? Ocugen or Lucid? Did that insight give us anything? We'll have to see. So we'll take a look next week, Fernando, and see if that gave us any kind of insight into what we're now. I just looked at one or two expirations here, but just across the board, we can see here on Ocugen that the calls have a higher IV than the puts, comparative strikes all across that expiration, 14 days away. And for Lucid, it was reversed. The puts had the higher IV at the equal strikes than the calls did.